Shell published its Q2 2026 trading update on 7 July, and the headline numbers make a striking pair. Integrated gas production collapsed to 610 to 650,000 barrels of oil equivalent per day, down from 909,000 BOED in Q1, a decline of roughly a third. Shares rose 3.1% to 3,002.74p in London morning trading, outpacing the broader FTSE 100's 0.3% gain. The two facts do not sit comfortably together unless you understand the mechanism at their center. Shell's gas production fell because the same Middle East conflict that is driving oil and gas prices to multi-year highs physically destroyed a facility in Qatar. The provisional answer to why the market bid the stock up anyway sits in Shell's trading operation, the division that profits precisely when prices are volatile, unstable, and hard to predict. That mechanism is what the market is pricing today, and what remains genuinely unresolved is whether that mechanism holds through to the 30 July full results. The question a holder must now answer is not whether Shell's Q2 looks good on paper. The update says it does. The question is whether a trading profit generated by a war is a durable source of value, or a windfall that will reverse the moment the conflict de-escalates. Those two readings of the same quarterly update produce completely different forward valuations, and the 30 July results are where the number that discriminates between them will first appear.
The production collapse has a precise address. Shell's Pearl gas-to-liquids facility in Ras Laffan, Qatar, the world's largest GTL plant, sustained damage from a missile attack in March 2026 and has been offline since. One of the facility's two trains was struck. Shell's initial assessment puts the repair timeline at around 1 year, said drag on the quarterly numbers. The same attack that shut Pearl sent crude and gas prices sharply higher. Brent crude averaged approximately $97 per barrel across Q2, up from $78 in Q1 and $67 in the year earlier period. European gas at the TTF benchmark averaged roughly 46 euros per megawatt hour versus 40 euros in Q1. These are not peripheral moves. They are the price environment in which Shell's trading desks operate, and extreme volatility of that magnitude is the condition in which commodity trading generates its widest margins. The trading turnaround is not theoretical. Shell's chemicals and products adjusted earnings, which include the oil trading desk, moved from a $66 million loss in Q4 2025 to $1.925 billion in Q1 2026, the first full quarter under war-level volatility. For Q2, Shell has guided gas trading and optimization within the integrated gas segment to be significantly higher than Q1, with chemicals and products trading expected to be in line with Q1, itself a record quarter for that division. The war damaged one asset and monetized another. Citi raised its Q2 EPS projection for Shell by 13% after reviewing the trading update, characterizing the numbers as incrementally positive and pointing specifically to strong performance in trading, chemicals, and fuels marketing. That is one reading of the same data. The alternative reading, that Shell's production base is structurally smaller than it was 6 months ago, and that $97 Brent is not a permanent state, is not absent from the articles. Both conclusions are being drawn from the same set of guidance figures, and that conflict is what makes the 30 July result the moment of decision rather than the trading update.
The margin improvements in Shell's downstream businesses look compelling in isolation. Indicative refining margins rose to around $20 per barrel from $17 in Q1. Indicative chemicals margins jumped to approximately $240 per ton from $139, a 73% sequential increase. Refinery utilization is expected to approach 100%. On the surface, the non-production segments of Shell's business are running at peak. The buried assumption in the market's reaction is that indicative margins and realized margins are close to each other. Shell itself flagged that they are not. The company stated explicitly in the Q2 update that realized refining and chemicals margins are lower than the calculated IRM and ICM and have been adjusted accordingly due to market dislocations. The gap between the headline indicative figure and what Shell actually captures in cash is precisely the number that will not be known until 30 July. Buying the stock on $240 per ton chemicals margin without knowing the realized figure is buying the upside without pricing the discount. The working capital swing is the clearest cash flow signal in the update. Q1 saw an $11.2 billion outflow that Shell attributed to unprecedented volatility in commodity prices. Essentially, the company had to post collateral and fund positions across its trading book as prices moved violently. Q2 is guided for a $1 to $6 billion inflow, a reversal of up to $17 billion in working capital terms. That recovery does not confirm that trading was profitable. It confirms that the extreme cash drag of Q1 is unwinding. Whether the trading profit itself is durable is a separate question, and that is the one that decides whether the current share price holds.
Shell enters the 30 July results with structural supports that have not changed. The share buyback is running at $3.5 billion per quarter, and management's prior guidance that the dividend can be sustained even with oil at $40 per barrel, against the current 97 Brent, leaves significant headroom. The $3.5 billion quarterly buyback alone provides a floor beneath the share price that is independent of the war's trajectory, and that floor is what anchors the stock against a scenario where the Iran conflict de-escalates before the Pearl facility is repaired. For holders, the position is defensible through the July results because the buyback and dividend floor limit the downside even if trading profits disappoint. The risk to monitor is not the production collapse. That is already in the guidance, and the share price has absorbed it. The risk is the gap between the indicative margin figures Shell published today and the realized margins it will report on 30 July. A holder should watch whether the $240 per ton chemicals margin and $20 per barrel refining margin translate into a realized figure meaningfully close to those levels, or whether market dislocations created a wider discount than the market is currently pricing. For a watcher considering entry, the move becomes a setup if 30 July confirms that realized margins tracked the indicative numbers closely, meaning the war premium is genuinely flowing into cash earnings. It becomes a trap if realized margins fall substantially short of indicative, because that would mean the stock is pricing a war windfall that has not yet arrived in the accounts and may not arrive in full.